Welcome back to Switzer on Australia's Business Channel. Now it's time to get the inside, the complex and the complicated mind of Rudi Filapek-Vandyck of FNArena. And tonight he's telling us the stocks he likes and the ones he does not like. Thanks for joining us on the program, mate.
Peter, after such an introduction, what else can go wrong in this year?
Look, any baby that was christened Rudi Filapek-Vandyck deserves an introduction like that. You've had a celebrated life, and here you are, giving us the stocks you like, you don't like. People got their pads out, they're really right with their iPads.
Probably fair to say I usually appear here and you don't even know what I'm going to talk about.
No, that's true. They gave you a bit of a heads up today, didn't they?
They did, actually. And I thought I'm going to combine this in a way with what I had in mind anyway.
Yeah.
There's roughly taken, there's two ways of looking at the share market. And it's, you can say there's a top-down approach and the bottom-up approach.
Yeah. For my viewers who don't know,
yes.
Explain the difference.
What you do with the top-down is you create a macro view.
Yeah.
And for instance, and that leads to the fact that you like certain sectors and certain strategies.
And Matt just said he expects growth, therefore he likes resources.
For instance. So I wouldn't go for that correlation. But anyway, no. Yeah. I'm just pointing out the correlation. Yeah. If you're a top-down one, you ignore the macro picture and you basically just pick out the stocks you like.
Bottom up, aren't you?
Yes.
Yeah, bottom up.
Yes.
You said top down. Bottom up.
Yes, that's what I mean.
So in a sense, you look closely at the businesses and see if you think
that's the bottom up one. Yes.
And that's what Roger does. Roger does that sort of thing.
Yes. Roger's definitely. He would never go the other way.
No,
yeah, exactly. So I've learned over the years that. I've made quite some good calls on the top-down approach one, and I do acknowledge you sometimes miss the bottom-up ones, but that's because you create a view from the top part.
And a classic example was a bottom-up approach. We've said don't touch Wesfarmers, but it's done well anyway.
Yes.
Yeah. And I think it's because it's been dragged along with the economy.
Yes.
The debt thing wasn't as big an issue, and I think they also got their business right. The Coles thing they got right.
Yeah. No, well, the best example in that context, I think, in my personal experience, is that I realized after 2007 that the overall environment had changed, and I selected a particular type of stocks, which I called the all-weather performers. Yeah. And that obviously came from the top down, and those stocks have killed it.
And they'll dividend stocks as well.
They've nailed it, exactly, they've nailed it.
Right.
And with the problem now, obviously they're all very expensive now. Yeah. And that's why you now see...
Are they very expensive or relatively expensive?
Well,
like, banks are still grossed up at about 7%.
No. I think we can definitely revisit that another stage. Okay. I think it would be a worry for me long term if the banks keep on going up. It will lead to a mispricing of risk, which already is happening. Yeah. And the banks being expensive is simply an extension of that. But anyway, that's discussion for another time. And that's a longer-term prospect as well. But of course, what it does suck all the entrepreneurial money out of the economy, and it's happening right now.
Yeah, and it means that there are companies out there that are good value because people have excessively chased other ones.
Well, let me put it in a very blunt way. And there is a trend now towards it that if boards are now going to please shareholders by paying out more dividends, and they're reducing the longer-term growth potential in their companies because they stop investing, that's good for the share market because share market has a little short-term view, but it's not good. No. If you're logical about that.
But at the same point, if you're just buying stuff for the sake of buying it and it blows up in your face, I'm thinking Rio and the aluminium business.
Okay, well, no, that's true as well. That's true as well. But anyway. Coming back to your theme and your question, see, from a bottom-down approach, I've been saying now for a while that, and that's a part of what happens in China and in global growth, but the dynamics in the resources industry are changing dramatically. And that's one of the reasons why I think too many people are still looking over their shoulder and thinking we're going to see a repeat of 2003, 2007. But that was exceptional.
Okay, so you don't like resource stocks now?
No, I'm about to get to that point. Okay. What I'm saying is the dynamics are changing, and therefore you will find that those companies over the decade ahead will find it more challenging. Yeah? Now, the irony is that if you are a big one, Rio, PHP, you have two things at your disposal. One of them is you can finance big projects and you can cut costs. The third one is, and that's people never buy resources stocks for their dividends.
No.
But the irony is that throughout the 90s, dividends were 50% of all returns investors had on the big resources. Yeah? The other irony is that since 2007, which is 2006 I should say, which is 7 years, all the returns on BHP and Rio have been the dividends. Yeah? And I think, from my perspective onwards, that what haven't investors really caught up on yet is that in the decade ahead, dividends paid out by Rio and by BHP will become increasingly important, even without the boards having to change their ways because there's at the moment a short-term pressure on them.
So you're saying if someone's prepared to punt on the fact that there could be reasonable capital gain in resources stocks, they might get a pleasant surprise that they'll get dividends as well.
It may be that dividends is the only thing they will have.
Yeah, that's the worst case scenario.
No, the worst case scenario is the share price will end up lower.
And dividends are crap.
And dividends are crap.
Yeah.
But here's the thing, yeah? While growth will become increasingly difficult for BHP and Rio, and I'm talking, I mean, we've had years of 80, 90, 100% growth in a year. Yeah. I think we're now talking, if they have 10% a year, it will be a big stretch. Yeah? But here's the advantage. Growth might not be there necessarily, but cash flow will be. And for instance, I wrote a story earlier where Deutsche Bank made a prediction into 2020 for those two companies. On their cash flow projections, Rio will increase their dividends by 50% by 2020. That's a lot.
That's definitely.
BHP will be a little bit less, because BHP at the moment is a better dividend payer. But what it also means...
But for retirees in the tax-free zone, it grosses up to a reasonable return.
Yes.
On good name companies.
Depends on what price you buy.
Yeah, of course.
Depends on what price you buy. See, I personally, I prefer to buy BHP as close to $30 as possible, because that means I'm getting close to 4% as possible. Yeah? But the other consequence also is, because dynamics have changed, there is a particular part which is going to be ugly and going to look ugly in the share market, and that's a trap as well.
Right, go on.
In the previous decade, the companies that did really, really well, and for instance, a company like Monadelphous, as I have pointed out repeatedly, did much better than BHP and Rio. They actually fed off their investments.
They're a mining service company.
Now it has turned. Because growth is now going to be challenging for those companies. The other guys actually been in the bear market now. But the danger now for investors is, and a lot of investors I know don't have that top-down approach. For them, the inclination is to think, because those companies have sold down so far, now it's a bargain. And where the trap comes in is that a lot of those companies are now trading on dividend yields implied of 8%, 9%.
But you don't think they'll be sustained? So in a nutshell, you're saying a lot of mining services company
seem to be offering a lot of dividend now.
May well have depressed dividends in the future. Be careful.
They will they will cut their dividends.
Okay, so far you said resources could be an okay for a dividend
dividends,
play. Be careful of financials.
With the other guys who seem to be offering high dividends, but they probably will cut it.
And you also say beware of mining services and the dividends, because they might not be sustained in the future.
Well, that's what I'm saying, yes, exactly.
Any other likes or dislikes before we wind you up?
Well, in general, I don't really have sectors, but in general, I'm like everyone else, I guess, on the lookout for smaller industrials, which have, because that's what what I said last time as well, a lot of people miss, is everyone thinks the market is only interested in yield. It's not true. The market actually is, because it's a share market, looking for sustainable, strong growth. It's just not there in spades. And I still believe there are mid-cap stocks out there that have growth potential, and some of them might even look expensive on a 1 year immediate outlook, unfortunately. But if the growth is there in the next 3 years, those stocks, what looks expensive today, they will look expensive in 3 years' time. But in the meantime, shareholders will have a big return.
Well, Rudi, how about this? You got 2 weeks before I see you again.
Maybe.
Why don't you hunt down a couple of those mid-cap companies that have value and share them with our viewers? You can put your money on first. So
no, that's not allowed. You know that. I can't do that.
I was just testing you on that sort of stuff.
Okay.
So, but one last thing before we get a wind up. do you think the economic outlook for both the global picture and locally is going to help those sorts of companies that you've been talking about, the resources stocks, over the next year? Don't go 2015, just say this year and 2014. Do you think the overall economic outlook is going to improve and help companies like BHP and Rio?
I have to answer in a different way, and that is that historically the correlation between an economy and the share market is virtually nil. So I think we focus too much on the economic picture. What you will find, and that's obviously one of the questions we're all facing now, what is remarkable is that Macquarie recently had a conference where 100 Australian companies presented, and the main theme of the conference was that every single one of them, all the business leaders, were preparing for an extended period of low growth. What that means is that probably they're all cutting the fat out, which means that they can, the potential is there that while the economy might remain sluggish, and I think it probably will, but that the companies might surprise us to the upside because they all become leaner, meaner, and stronger.
And the irony is that it's a self-fulfilling prophecy, because if all companies are cutting back, they're investing less.
In a way it is. But obviously the big question is that are we now going through a new era, and the US economy annex share market sort of is suggesting that we might be in such an era, because they have been cutting their costs for a long time now, and they're still growing today and surprising to the upside.
Okay, given the fact you finished on a relatively negative note.
Really, did I?
Well, relatively negative. Looks like I'm going to have to get Clifford Bennett on the show to bring us back up into optimism land.
We all need a panel after that one, yes.
All right, mate, thanks for joining us on the program.
Okay.